Welcome back to Street Smart. Ben Bernanke and his colleagues at the Fed have been talking about an exit strategy from their current easy money policy. We learned this afternoon in minutes from the meeting at the end of April that members favor a strategy of raising rates before they sell assets. For a closer look at the central bank's comments and their effect on the equity market, let's bring in Scott Minerd, Chief Investment Officer at Guggenheim Partners. He oversees $100 billion in assets. Scott, welcome to Street Smart. Thanks for joining us again. What do you think about the end to the easy money policy? I mean, a lot of people have said we're kind of like a junkie. We need our fix. We can't give it up.
Well, I think there's a lot of truth in that. I think that the minutes today began to lay out a roadmap for removing the stimulus. But the reality is we started talking about this back before QE2 started. So I think the Fed wants to assure the markets that it has some plan to take away the liquidity. But I don't see them taking away the liquidity anywhere in the near term.
Do you see us getting more? I mean, for a while there was talk of QE3, QE4, QE26, and all of a sudden it seemed especially after the press conference, that a consensus was building that this was indeed the end of quantitative easing.
Well, that's right, and I think that the conventional wisdom at the end of the press conference was wrong. Dr. Bernanke clearly left the door open for more quantitative easing. And not only did he leave the door open for it, but he gave us the roadmap to get there. When he talked about price pressures being transitory, he opened up the door to the idea that in the future we could be seeing lower rates of inflation. And if you remember in that press conference, he discussed that the trade-off of the decision of easier money and lower or more quantitative easing was an easier decision when price pressures were lower than when price pressures were higher. So I think he's basically set the stage to say, if price pressures are transitory, if we see another dip in inflation and we don't see a recovery in the employment sector, then quantitative easing is on the table.
What do you think about the current picture in stocks, though? I mean, obviously we're up today, but we've seen indexes come down over the last couple of weeks. We're in the third week, I think, here of losses. Is the market aware that easy money is going to continue, or are we bracing ourselves for the end?
Well, I think that the market is continuing to move forward on momentum. The best indicator I have for market prices over the near term is breadth. The New York Stock Exchange advanced decline line continues to make new highs. Usually the advanced decline line will turn down about 2 or 3 months before the market peaks. So for the moment, we have a green light on the market, and I think that though I believe this rally is a rally to sell into, not to buy into, I do think we're going higher.
I wonder, because we've gotten so many negative signs. I would say the housing picture here again looks bad. You've got the Bank of Japan saying that they're in a very serious situation there, dire situation for their economy. You've got basically all signs pointing to a restructuring coming soon, imminently, for Greece. I mean, it seems every continent has seriously negative issues. So why would you be optimistic in this market?
Well, I think for one thing that the U.S. is, as Bill Gross has called it, the least dirty shirt in the bag.
He still doesn't like treasuries, and we continue to hit new lows on yields.
Well, and that's where he and I don't agree. I think we're going to see lower yields before we see higher yields. But there is a lot of capital that I think is moving out of Europe into the United States. There's a lot of money pouring in from overseas. And one of the interesting things about treasuries, Matt, that I think a lot of people have just glossed over is the fact that given the argument and the debate in Washington over the debt ceiling, the supply of treasuries is going away for a period of time. And that is the incremental growth in treasuries. And so as the Fed continues to complete QE2 and there is an increased demand for U.S. securities, I think we're going to see treasury prices move higher and see rates continue to go down. What
about the U.S. equities market? I mean, Staples today is reminiscent of Hewlett-Packard a couple days ago. We've had some really serious tech disappointments in this earnings season. It looks like earnings growth has plateaued, and we're now, although growing, coming down as far as the levels.
Well, that's right. And I think that what we're finding out is that the price pressures that are in the pipeline that we've seen in producer prices cannot be passed on. And so margins are getting squeezed. But having said that, the multiple on the market is very reasonable at the current levels. And based upon the Fed model where long-term rates are, the market conceivably can support a much higher multiple than it has. So I think even without earnings growth, multiple expansion could carry us higher.
And Scott, before we go overseas, because I do want to touch on that, I want to finish our U.S. conversation here. And the markets, you say, are trading at a decent multiple and could, or a cheap multiple, and could get even more expensive here. I'm looking at 15 trailing estimates and actually estimated PE on the S&P of just 13.5. So where do you see us going?
Well,
where should we be?
Well, if you use the Fed model tells us that the fair multiple at this point, based on long-term rates, is about 22. And
trailing.
Yeah, trailing. And that's based on the historical data of where we've been in the past, and we have been at those types of multiples before. So it does seem a little bit crazy relative to the period we've been through, but as I said before, I find the conventional wisdom is usually pretty misleading in terms of making investment decisions.
So, but you don't expect markets to go straight up to that level? I mean,
no. Matter of fact, as I think I said earlier, I think this is a rally to sell into, not to buy into. I do see pressures coming up here. The end of QE2, more talk of fiscal austerity, rumblings of the things you were talking about before the break, of problems over in Europe, which are real. At some point, it's going to raise enough uncertainty in the market this year where I think we're going to have a substantial pullback, a correction, if you will. But I do think that before it's all said and done, after that correction, we'll probably get to levels higher than we are today by the end of the year. And as I've gone on record, I'm pretty bullish on equities over the next decade. And I think they offer returns of somewhere between 6 and 9%.
So you're looking for a big dip basically this year. You want to finish higher though, and then going forward, you're very optimistic about U.S. markets. It's interesting because you are not terribly optimistic about the situation in Europe, right?
No, I'm not.
So how bad is it over there? I mean, we're looking at a soft reprofiling. They continue to get better and better language for defaults, right?
I loved that yesterday when I read that from Juncker. But look, when you look at the size of the scale of the problem in Europe, 40% of the capital in the Portuguese banking system is invested in Greece. If Greece restructures, we have a problem in the Portuguese banks. The Portuguese banks are going to have to be recapitalized. Where is that capital coming from? Portugal doesn't have it. Then we're talking about restructuring Portugal. Well, if we restructure Portugal, 60% of the capital of the Spanish banking system is tied up in Portugal, and then to follow it on, 80-odd% of the capital of the German banking system is tied up in Spain. And that's without aggregating the numbers and adding them together. But when you do add all of it together for all the pigs and the exposure in the European banking system, over 200% of capital is tied up in the pigs for the European banking system. And to put that in perspective, the number is actually larger as a percent of total capital than all the home mortgage exposure was prior to the subprime crisis in the United States.
So you basically expect possibly a bigger disaster there than the Great Recession we've just gone through here.
That's right. Europe could be facing a much harsher downturn than they experienced in the last downturn that we had as a result of the subprime crisis. Interestingly enough, that's exactly what happened back in the 90s. In 89-90, when the U.S. had its housing and real estate recession, Europe kind of got through it unscathed. But yet, 4 years later or 3 years later, they were in the exchange rate crisis, and all of Europe went into a recession. So I think that very likely we'll have a European recession within the next 24 months.
All right, good to end the interview on a positive note. Scott, thanks so much for joining us. Scott Minerd there from Guggenheim Partners. Now